All right, everyone, welcome back to another episode of On the Margin. Today, I am joined by George Goncalves, the head of U.S. macro strategy at MUFG. George, welcome to the show.
Great to be on. Thanks for having me.
Yeah, you bet. I'm really excited. You put together a really great presentation for us today. So if you're following along via video or via audio, I highly recommend actually head over to the YouTube and check this out because George has put together some really great charts and walked us through, I think, one of the more compelling sort of descriptions of what's going on in macro today that I've heard in some time. Basically, George, I would love to sort of get your version of the big picture here. You've put a bunch of your main views kind of on this slide, and if you could just kind of walk us through sort of the high level of what we're looking at here.
Yeah, absolutely. And we'll get into this more in detail as we go through the PowerPoint. But there's a big debate going on right now. There's this idea that these historical recession indicators that we've relied upon for basically every single business cycle, or post World War II, but even before then, a lot of signals that kind of confirm if you're heading into a slowdown. But at the same time, I believe that this cycle has been so unique for so many different reasons, which we obviously know post pandemic. The sort of fiscal as well as monetary response, and now the unwinding of that, or the lack of fiscal response, has led to probably what took place was an extension of the prior business cycle, which we can get to in a moment. So I think that's important because that really sets up the stage for. There wasn't a really kind of a cleansing process on the credit side. If anything, we continued along with the same sort of credit issues that never got resolved. I do think we'll get into in a moment as well that although the one last kind of coincident indicator that's been suggesting that the economy is relatively healthy is the jobs market, but even there's cracks that are forming, and I think that maybe it's not as robust as many believe. And inflation is heading in the right direction. It's the hard part will be like where does it settle at, and what's going to be that level where the Fed's either going to feel okay to start going the other way, or is there some other catalyst that forces the Fed's hand, or maybe it's a combination of the two. Typically, you kind of get to a situation where inflation can just collapse out of nowhere because something bad has happened in the world, and then you see a real crash in prices. The big one here, which I think also has been kind of percolating out there, is the idea that somehow the U.S. can decouple from the rest of the world, ROW being rest of the world. The rest of the world is decelerating, and it's going to be hard for the U.S. to overcome that if truly we're starting to see a global recession starting to form in different areas of the world. We'll get into the Fed in a moment as well. Hopefully, it'll go through their policy stance right now. But in many ways, the Fed's aggressiveness on their tightening side almost feels like they're fixing one policy mistake from the past with another, by not really taking into account these long and variable lags, as well as the ongoing QT. They don't like to focus on the QT, but it's still there, and I think they really want to extend the shrinking of the balance sheet as long as they can. And then on the flip side, one of the things which kind of ties into like the market's reaction function is, people think that, well, if things get bad enough, the Fed will come and save the day. I think that also has to be thrown into the dustbin. The idea that the Fed's going to come and do QE again, as well as slash rates back to zero after having just seen what they've done here, I think it's a relatively low probability. And if they do, that means something really bad happens. So you don't want to be kind of cheerleading that on. You want to avoid a worst case scenario. And so in many ways, the Fed massive easing campaigns of the last 2 decades, I think that's probably also going to be hard to come by. And in reality, we'll start to kind of settle in and figure out what is really necessary for both the banking system and for the economy. And they're not going to come in and be as aggressive as before. They do have room, though. The good thing is they do have room to kind of tweak policy. But the idea they're going to just do massive easing, I think that's also gone. But the problem, though, like the risk markets still operate to that model that the Fed's always going to come in and save the day. I'm a fixed income and rates professional, and my focus is primarily on the fixed income markets. Even though I'm a macro strategist, I look at the macro strategy through like a fixed income lens to kind of see like what the bond market is telling us. That's my area of expertise, and the bond market has been skeptical, and I think they have the right to be at this point.
Yeah, George, so much of what you just said there resonated. And I want to sort of move in order here because so much of what you put together just flows so nicely. But really, some of the points that immediately resonated with me was this idea that the US can't just decouple from the rest of the world. And the idea of the Fed sort of fixing one policy area with another, kind of this cycle of overcorrection really resonates. And I'm excited to get there and dig in with you. I would love to kind of start here on, the big picture. And you sort of described what we're seeing today as a continuation of sort of the old regime. And I would love to maybe explore what that is. And if you could define, what the prior cycle sort of means to you and how this is a continuation of it, that'd be super, super helpful.
Yeah. So look, I mean, obviously, there's elements that are unique to what um, we're experiencing now versus the past cycle, which many like to define the 2009 2019, which was the longest business cycle that we've had in U.S. history. Of course, obviously, we had the pandemic and the health issues that came along with it, and which led to a big disruption on the economic side as well as on the health side. But if you kind of put that aside and you focus on how the economy was evolving underneath, we were already in 2018, 2019 already seeing a deceleration in the economy. The Fed tried to do insurance cuts, I should say. That's what they were calling it. They might end up doing that again in the future, calling it insurance cuts sometime soon. But nonetheless, they tried to soft land back in 2019 to 2020. And of course, nobody could foresee exactly what was going on there. But the yield curve was already telling you there was issues forming. The economy was slowing. You had a massive impulse on the other direction with the CARES Act and all the Fed easing, which in many ways kind of just elongated that cycle's malinvestment period of many like 20 to 30% of the Russell 2000. Many of these companies can't afford the interest rates that we're going through now. These idea of zombie credits that can't afford their interest costs based on free cash flow. That really was kind of postponed, in my opinion, with the epic stimulus efforts that we saw there. So then that puts us into the current environment, which it looks like it has been acting like a classical boom bust cycle, which we had the massive reopening boom, all the stimulus, all the pent up demand, it burnt out, and now we're on the other side of it with we had some inflation pressures, which a lot of it attributed to the excess money printing and the shortage of goods as well as services, and that leading to an inflation shock as well. The thing is that inflation shock persistent? Is it going to stay with us for the next 3 to 5 years? Was it just like specific to this time period, and we're going to go back to the 2019 or COVID world? Probably not exactly on the inflation front. That's probably what's going to be different this time. But nonetheless, I mean, the issues around demographics, the issues around just the way structural features of our economy, I don't think that they were completely rewritten just because of the pandemic. And so I feel like there's, especially on the credit side, like a lot of these issues were never really addressed. And we needed low rates for such a long time period to persist. And now that we don't have low rates and we have also wider spreads in credit, I feel like it does create, which we'll get to more later on, like a have and have nots, access to liquidity, access to easy money or not. And all of that matters now. I think so. So now I feel like what the Fed's actions have led us to now expose some of these realities. We haven't seen the full effect yet because it takes time to work its way through the system, and we live in a very impatient world where everyone wants to see, like, well, there's a cause effect. The Fed did this, therefore something should automatically break today. Well, it takes time to kind of build up in the system, and I think it is. And so I think we're going to expose some of these malinvestments over the course of the year into the next year. And that will eventually probably force the Fed's hand and go the other way. But until then, it's kind of this chicken and egg between when do these credit problems really surface?
Yeah, you're absolutely right. And, I'm just sort of remembering here, George, you reminded me, pretty sure the yield curve, the tens and twos actually inverted before COVID anyway. So did that
That's right.
predict COVID? Hard to tell, but that has been a pretty reliable indicator. I know, some folks question its validity, but definitely seems to be proving up now. I would love if you could kind of walk us through, for those who aren't following along via video, you sort of outline a couple of different perspectives here, right? Sort of ranging from the Jekyll and Hyde rose tinted glasses to the Goldilocks soft landing to the sticky CPI gray area, and the markets will be having blues. And you sort of outline sort of the stages of the impact on the macro economy, what central banks will do, and then the market outlook. So obviously there's a lot of information to go through here, but could you kind of just walk us through these different scenarios and then which camp you sit in?
Yeah, absolutely. So look, these are four of many camps that could exist. Let's be clear about that. But I think this kind of captures a lot of what we're debating in the markets at this moment, which is, can we soft land? I mean, that's the ideal scenario. The Fed, I think all policymakers, their attempt in all their actions is to try to do the right thing. Sometimes they over engineer it, and we end up on either side of what was the intended goal, right? So I think soft landing is the goal. I'm not sure they can have that happen, considering all of the legacy issues that we just discussed, as well as how much prescription of tightening they put in place, as well as QT is still ongoing. But Goldilocks is the aim. I assign a very low probability of that happening. I think we are bouncing along the bottom, very close to a recession, if not probably in one. Let's see how things look like in the next 6 months. But and it's always a backward-looking assessment anyway, right? So things don't look that great. I think it's really just a jobs market that everyone focuses on. I'm more in the blue camp, which is, if people visualize this on screen, they'll see like this table, and I think markets will be having having the blues, I call it, at some point, because the idea that we can decouple also from markets and the economy for a long period of time, that I don't buy either. So I think that the economy decelerating further and not having the Fed to come into the rescue anytime soon, and this higher cost of funding and credit issues eventually rising to the surface, we'll see the markets finally get that message. But in my opinion, actually the markets having that kind of that last cathartic moment and realizing that, hey, we're not in this virtuous sustainable recovery, that we're going to see this final kind of flush out type move in markets, will then allow the Fed to react to that sort of outcome, number one. And it would also kind of rip the Band-Aid kind of experience, and it would probably kill inflation. So in many ways, like having that last cathartic type move where, it will result in sort of a wealth destruction time period, but it kind of levels the playing field and cleans up some of these bad credits that are out there. And then the economy should be able to grow more organically, and the Fed will try to re-steepen the yield curve, try to help the banks get back online with lending. It's not going to be overnight. That too will probably take a year or so process. But I'm much more optimistic on the latter half of 24 into 25. But I think we're going through a transition period that we're just still dealing with again, decades of low rates. Then we had that massive stimulus injection post COVID. And then on the flip side, the pendulum swings all the way the other with what the Fed has done. Things break in all these big moves. But I think the sooner that actually gets realized is probably better, because the worst case scenario is really what I call here the sticky CPI, the gray area. If I'm wrong on inflation and we actually are in a stagflationary world and the Fed really can't address it at all, and actually has to raise rates even further, which I don't think they should, then we have a big problem because markets are not ready for that. They're obviously ready for a Fed that can come to the rescue at some point. And then on the flip side, which I think, which drives a lot of kind of the fear of missing out, is that, well, things are great. And if they're not great, then, the Fed will rescue. That's the whole Jekyll and Hyde of the market, and like viewing things from a rose tinted glasses. I think that I assign a very low probability to that. And so I'm kind of skewed towards, I'm either wrong because I get the inflation picture wrong and we're living in a stagflationary environment, or we're going to have that cathartic move sometime between now and the end of the year, early part of 24, and then we kind of clean house and we move from there.
Yeah, I totally agree with that assessment, George. And I want to get on to, I know you've got some thoughts on the job market and how that might not be the steady indicator or the sort of sign of strength that many in the market think that it might be. But you've got some really great slides here on some sort of leading some macroeconomic indicators. And You've got a
Yeah,
really great chart here of sort of the conference board leading index versus real GDI as a percent year over year change and mapping those together. You've got bank credit shrinking. So happy to sort of take your lead here. But if you want to maybe call out a couple of these more leading indicators, I would love to know why you highlighted these and why they might support your
yeah.
views.
And look, I mean, I think all of these, and there's many, there's plenty more that we can always look into. Maybe we can just look at the LEI versus real GDI on page
Yeah.
10. I mean, this is just as good start because there's again been a growing chorus of forecasters dismissing any sort of leading indicators, that they're all somehow broken because of many of the things I just described, that we've kind of seen the pendulum swing around too many different directions, that perhaps the economy isn't that weak and that these indicators are picking up on the wrong signal, and therefore they're kind of biased at this point, that we can't rely on these historical signals because something has changed dramatically in the economy. I don't buy that. I mean, I think, and the reason why I compared it versus real GDI, just kind of looking through, and a lot of the work I do is try to figure out, is there any other corroborating evidence, analogs and parallel sort of comparisons. And this looked pretty good to me, looking at GDI versus LEI, where the two of them are tracking together. And when they both are negative, we are likely in a recession or heading into a recession. I mean, it's worked since the 1970s. I mean, I think I share a view that some others do as well, that we've been scarred by the big shock of COVID and how fast it was, and how disruptive it was. The same thing for 2008, 2009. We have these financial shock type recessions that we're so fearful of. More likely, this is more like the 2000, 2002 type period, or the 73, 75 period. I think there's a lot. Those are more standard type of recession periods. They still hurt, but they're not as disruptive, and so I feel like those are better comparison points. But even back then, you still see the LEI worked as a signal, and so did the real GDI, going either negative or close to zero. Either way, that is probably a better indicator of what the true health of the economy is, if income on a real basis is not growing.
Yeah, I'm in complete agreement with you there, George. And one thing that I think is worth calling attention to as well is we're going to get into this in the when we talk about sort of the Fed potentially trying to fix one policy or with another. But so much of what we're going to talk about, especially when it comes to the unemployment, the jobs market, is backward looking.
Yeah,
Right. So maybe you could talk a little bit about that. And if you wouldn't
yeah.
actually
Maybe
mind,
page
yeah,
15, and then page 16. Both of them kind of lead off each other well. And there's a few more here.
So
Yeah,
maybe to tee you up on this slides, and I'm actually going to ask you to just do a little bit of definitions here because people kind of throw a lot of terms out. There's sort of JOLTS, right, as a job number. There's also continuing claims versus initial claims and all of this stuff. And I would love to sort of get your perspective on teasing out the signal from the noise here. But maybe we can kind of start with this idea of the white collar hoarding recession, right, as you call it, and
yeah.
why sort of a recession that's appearing in more white collar jobs might not be impacting the statistics as much as we might expect.
Yeah, no, absolutely. And so first and foremost, the higher paid jobs are less in terms of the overall population, right?
Yeah.
So I mean, I think that's number one. But they do have a multiplier effect, which leads to consumption downstream, right? So wealthy individuals and people that are high paid will then consume more services and goods, and that obviously trickles down through the economy. So it's not to kind of poo poo it, but it is still more of an isolated type white collar recession so far. A lot of it tech, financial. We haven't seen really construction job layoffs, and that's something that concerns me, especially after we're recording this on June 20th, right? We have the pretty big housing numbers, and everyone's trying to point
Yeah.
to the idea that, well, look, see, housing's doing great. Well, because I think all the builders want to finish their work, and they're really getting stuff done, and whenever there's a window to produce, and there's demand now because there's not that much supply in the housing front. But nonetheless, I mean, we need to see other parts of the jobs market see losses, not just in the white collar side. And I mean, many have mentioned this, so this is not an idea that's novel to me. But the idea of labor hoarding, I think, is a true issue that is out there, and I haven't quite figured out the right term for this. I think the Wall Street Journal had an article saying a full employment recession, which kind of feels like an oxymoron. There's no full employment recessions, so that means that we're not really in it yet. So we haven't seen the real job losses pick up yet. But if you look at this chart on page 15, and you kind of scan over to the beginning part, like in
Yeah.
2001, 2, 3, coming out of that recession, we actually saw the unemployment rate continue to go higher. So ironically, people think like, oh, once you get into a recovery, then jobs are going to come back, and then once growth starts to tick up again, you see a full recovery in the jobs market. But in that period, that people were calling that the jobless recovery, where you spent about 2 years post recession still seeing unemployment rate high and actually ticked higher because productivity was being maximized and people were just kind of making the most of what they could with their current labor force. This time around, for now, it feels like a labor hoarding, white collar specific recession. And we don't even know if we're in a recession yet or not. And maybe this is just going to blow over. But I do think that comparing the unemployment rate, which is one of the slowest of the slow indicators within the jobs market data set, versus the Challenger Gray, which is more of a forward, looking and actually real time, more not forward looking, but much of real time indicator on an annual basis. Whenever the Challenger Gray's layoff data goes higher and quickly, like it did now, as well as it did during COVID, as well as 08, 09, as well as in 2000, 2002, whenever there's a big spike there, roughly about a year later, we get a higher unemployment rate. So I think that this one still holds true. It's not proven yet. And this is, again, goes back to what I said earlier. We're an impatient set of individuals now because we have social media, we have access to all this information. So we expect instantaneous reactions in the real economy. It takes time. Employers just don't go out and wholesale lay off their whole staffing. They also have hope too that things are going to work out. And I think they're labor hoarding.
Hey everyone, we'll get back to the show in a minute, but just wanted to let you know that we've got our permissionless conference coming up. This is the one that we do with Bankless. It is the biggest and best conference in DeFi. It's going to be in Austin, Texas this year, September 11th through the 13th. If you've been in crypto for a while, you know that bear market conferences are the best conferences because those are the ones that all the alpha's at. This year, we've got a phenomenal lineup of speakers, and the topics that we're covering are insane. We're going to be talking about ZK Tech, roll-ups, account abstraction, MEV, app change, the whole suite of stuff. I cannot wait myself. So, because you're a listener of this podcast, you're also going to get a discount. Type in PODS20 and you're going to get 20% off your ticket. Click the link at the bottom of this episode and go get it now because prices go up every 2 weeks. Yeah. And so I hear you on that, George. And honestly, if you're not following along, guys, via video, this is a very stark chart where you're sort of looking at the US unemployment rate, which has spiked way up during COVID and has been on a steady stream down. But we're also looking at this Challenger Gray layoff index, which has been really spiking at the same time that the overall unemployment data has basically remained unchanged. One thing I'd love to poke at you there, George, is on the one hand, I could see, hey, if you've been hiring for the last 18 months or 2 years, there's a pretty good likelihood that hiring was your biggest challenge, right? It was a big pain point for a lot of employers because the job market was so hot. It was really tough to get labor in. So once you have that labor in, I could see you really holding on to it. On the other hand, we also know that what happened during the post-COVID era is that salaries went totally nuts, right? And all you hear about is sort of people complaining about the comp that people wanted. People wanted to work from home, yada, yada. So I could also see a scenario where, now that it looks like demand is waning into the future, and it seems like there might be the leverage might have shifted to the employers as opposed to the employee. I also it would make less sense to me to actually hoard that labor because, I would think from the perspective of an employer, you could think if I just wait another 6 months, I'll just get this all on sale. So what would you have to say to that pushback?
No, those are great points. The former, and really that probably is what's been happening. There's been challenges hiring, skilled labor and getting the right person in the right spot. I think that is definitely true. And then that does kind of skew the behavior of management to actually, at corporate America or even small and mid-sized businesses, they're just not going to turn around and start laying the people off just because they're seeing a slowdown in activity in their sales, right? They'll kind of allow some margin compression. And also, let's be honest, all throughout this period, this has been the saving grace, which people sometimes forget about this. The saving grace for corporate America actually has been inflation in a weird way because they've been able to mark things up too. So you've had profit expansion. Inflation kind of masked that a little bit. Yes, wages went up, but corporate America had decent earnings up until recently. Now they're on a steady decline because you're chipping away at, you're having a slower economy and you have your costs are basically set or rising, especially on the biggest cost, which is your labor. That it starts to kind of see the profit margin compression. But for now, like that's a slow process, and there's been a lot of work saying that you just don't want to lay off people right away because you just don't know. You want to see through it. Like this idea, a lot of people will say we're going to see through this, and then if it's a mild recession, we can kind of get through it. Versus just the highly disruptive nature of hiring and then firing and then retraining. It's a lot of
A
work
lot.
on the part of right. So I think that is definitely true to your point. Now, will there be leverage back to corporate America, and like will they be able to then see like slightly lower wages? I mean, in many ways, that's what the Fed is trying to engineer. They're trying to
Right.
get wages to not create a price spiral, a wage price spiral. They're trying to avoid that. That one, the jury's still out. We'll see what happens, and it really will come down to do we have the recession and the severity.
Yeah. So I guess just looking sort of holistically here, George, I mean, how would you, if you had to sum up the state of the employment market in the US, I mean, how would you kind of do that? Because on the one hand, I hear you with there might be some labor hoarding, and there's certainly been a sort of a jobs recession in terms of more white collar jobs, but we definitely haven't seen that in the larger sort of data set. So if you had to kind of sum it up, I mean, what's the current state, and why is it a little rockier than we might think?
Yeah, look, I think it's solid on the surface, but cracks are forming underneath. I
Mm,
mean, I think that's how I would sum it up. Maybe let's go to one or two more slides on the jobs market because
sure.
this is probably the area where I think most people that are bearish on the outlook get the most pushback, which is look at the jobs market. It looks great, so therefore everything must be great, right? But let's look at page 17, for example. This is looking at hours worked versus multiple job holders inverted to kind of prove the point. I mean, many times when you're again going back to what I described earlier, you've hired all your staff. You're not going to turn around and lay them off. You might start cutting out back their hours, right? So there's an element of that going on here. You can see the gray line has been declining really quickly since 2022 started, and all throughout this year into this year. And the red line kind of has a visual correlation with it that there's more and more multiple job holders. So be it people working two jobs because they want to have the flexibility, or maybe because they're being forced to because there's no other real full-time employment. And you can't build a sustainable jobs recovery based on part-time jobs. You need to have full-time employment. That's super critical. So I think these would be like two of the many cracks that I see. If we move forward, there's the temp workers. Many people have kind of focused on this too. Temp workers have stopped rising; they're actually starting to head lower. When that happens, shortly thereafter, we get higher unemployment rate. And then if we go to a chart that page 20, which I think will be really critical to tie in the signal stuff that we were discussing before, because
Yeah.
again, there's a growing body of forecasters that are trying to dismiss the yield curve, and I think that's wrong. This is looking at and so what I do here on this chart on page 20 is looking at the two big yield curves, the 2s10s versus the 3-month 10-year, the shorter term one. And then I have the recession periods highlighted, so we can see that truly curves do invert typically before recession starts. So that's so far so good. The curve has been relatively on point with that. And then I try to combine what we're getting from the jobs market, which again, I think there's cracks forming. I just described a few of them, but another one is this, which is now 2 weeks running. We're seeing higher weekly claims data. So that's a higher frequency jobs data, right? So the weekly data is super critical to watch. It's been over 260. And then the other one is the continuing claims. So those that are on unemployment for a continuing basis. That's the purple line underneath the yield curve. And so what I found in my work is that whenever you see the continuing claims go from improving, so improving would be negative, means there's less people on unemployment. When it crosses the zero mark and starts to go positive, that means that there's more people on unemployment. When that happens at the same time as the yield curve is inverted, it pretty much just tells you we're in a recession or we're heading into one. It has this is like a good kind of an example of combining two different data sets to kind of make this point that the claims data is also signaling that we are likely in a recession or heading into one, and it happens exactly at the same time when the curves are at their most inverted and starting to re-steepen. Like all these signals are there. So maybe they're all wrong, and
Mm.
this time it's not going to work out. I just feel like those that are dismissing all this historical fact are doing it for some other reason.
Yeah. George, this is such a great chart. And maybe you can, just to add a little bit of color, and maybe you can correct me if I'm incorrect here. But, the twos and tens, that's typically what people talk about when they say the yield curve is inverting. That has a very good predictor of being a recession. But it's the 3 month and the tens that has, I think, a 100% track record of predicting recessions. And I really like that you put
Yes.
continuing claims as opposed to initial claims here. Because to me, continuing claims says these are people that, consistently can't actually find work. Right. So I think putting these two things together just paints a great picture of where we're at just in terms of the economy. And this is, what I wanted to sort of get your opinion on here. And we've highlighted it so much on this show, but you know, unemployment is, if you started off here, we know that monetary policy acts in long and variable lags. At the very beginning of monetary policy, if you charted out a series of reactions, then unemployment or the jobs market would be all the way at the end of this. And we know
Yeah.
people ask, well, why did Powell, stay easing so long despite inflation starting to pick up above 5%? We know that he was looking at the labor market. That was at least part of what went into his decision. And that was lagging post COVID in the wrong direction. And now we know that the Fed is probably looking at the labor market and they might be doing the exact same thing here, right? Where all of the forward looking indicators, and we can get into it here because you've got some phenomenal charts, some of these leading indicators, they're pointing straight down. But the labor market, which Powell and the Fed pay a lot of attention to, is still being pretty stubborn. So would you say that's like about the state of where we're at right now?
Well, that's exactly where we are. We're in this point of ambiguity where we don't
Yeah.
know. And then this is true for the Fed. They don't know. We need to kind of have our anchors of like what we're looking at, and we're still focusing on the job market potentially, resulting in inflation becoming stickier and persistent, and therefore, we're like these other indicators around us, although they have merit. It's not really their mandate per se to be guided by them, right? So they're focusing on this backward looking indicator. The Fed has a very unique sort of mandate, both full employment slash stable prices, and that's a really hard thing to do after the disruptions that we've had. And so the pendulum just keeps swinging back and forth. Eventually, they're going to get it right, but it's going to really require a more activist central banking type world. They should just not be only in one direction. So my view is that they're going to get rates. Well, the rates are pretty high. And I think they should stop here 50-50 on July. They should not be hiking considering the data that we're getting and the outlook that I kind of just went through. But nonetheless, they can do whatever they want. If they want to raise rates, that's going to be the first rate that they unwind it at some point soon. But basically, they're at this point where it doesn't make sense to be creating further action, but they don't know any better, and they're gonna do that until they get it right. And I think later on we'll find out that they're going to become much more activist. Where they'll one for a couple of years they won't hike, and then they'll hike 100 basis points, and then cut 100 basis points. Like I said at the beginning, I don't think they're going to go to zero rate policy unless something really bad happens. But I think they're going to start to get their cadence on how to adjust policy, not just go in one direction, 500 basis points, and then 400 basis points in the other direction. It's too disruptive.
Yeah, I completely agree with you. But so basically, everything that we've talked about so far feels like maybe we're not on the edge of Armageddon here, but there are definitely some tremors starting to form both in the economic data and in the markets. And, one emerging narrative that you've highlighted that feels a little funny given all of this data that we've just gone over is people seem to think, oh, well, yeah, the rest of the world, they are certainly due for a recession, but I don't think that's super likely to happen over in the US for XYZ reasons. Can you detail where do you think that narrative comes from? What are those XYZ reasons? And do you think that's realistic that the US could sort of be the shining city on a hill while the rest of the world is mired in recession?
No, I mean, I think it probably starts off with, as we discussed in the beginning for pre-show, the hopium idea, right? Like as you described it,
Exactly.
and I agree with it. There is hope. There's a lot of hope that somehow we can avoid the worst case, and the U.S. being still the largest economy, and it's been performing relatively well versus its peers, but again, still decelerating. Let's not forget that we had a boom bust, and we're basically growing 1% or less, which the margin of error falling into a recession is very high when you're at this low growth rate. So I think there's just this idea that somehow U.S. will always kind of pull through it, and I think they will, but not until we actually see some of the issues I discussed in the beginning get addressed, and also the Fed having to eventually turn the corner and have to re-steepen the yield curve and get the banks back engaged. Like we haven't even touched on the banking part yet, which we can if we have some time. But I do think that the banks themselves are introducing a form of tightening which hasn't been fully felt yet. And so, like the Fed's at odds with a lot of pressures against them. They have this one tool or two tools, but they don't really focus on the QT as much as they should. They're focusing on the rate channel, and I think that they're overshooting in a big way. But yeah, this chart that we have here on the screen, if we're looking at it,
sorry, before we get into
yeah,
that chart, I would like to poke a
yeah.
little bit at what are your thoughts on the banking situation? Because it's been, looking back, only about 6 to 8 weeks since we've had a major bank failure, both in the US and abroad in the form of Credit Suisse. People seem to have think that we've moved past the problem. I don't know if you ever read Matt Levine from Bloomberg, but I just love the way that guy puts it sometimes. And he had this great column today, which again, we're recording this on the 20th, which was there's he's to really paraphrase here, but it seems like there's a whole generation of asset managers, bankers, et cetera, that just didn't really account for the fact that rates might go up and that might cause problems for their balance sheet. He's got a much nicer way of saying it than I just did. But what's your sort of assessment of the banking situation? Are we past the bulk of the crisis? And if we're not, what is going to be the impact of the credit tightening? Because we're definitely starting to see that.
Well, this is the whole point. Like as I said before about the chicken and egg, and then in order for the banks to get some relief, the Fed's going to have to ease rates. But in order for the Fed to ease rates, we're going to have to either see inflation come much lower, much quicker, which could happen. This idea that people have the immaculate disinflation, that everything works out, inflation goes back down, and it's going to be smooth sailing. Maybe that page over there. I don't know if you want to go back up, page 23. I think that's probably the best one that captures all of these cycles where we've really only ever had two soft landings in the 1990s, mid 90s. And also that's really the only other time in the mid 90s is when the Fed stopped, eased, and then hiked again, and then eased and then hiked again. Like that was actually activist central banking at its best. I mean, during the 70s and 80s, that was really reactive and highly disruptive. There's big spikes up and down, the 1, 2, 3 that I showed there. And then in the late 60s, we had another soft landing after the Fed raised rates. But typically, Fed raising rates eventually does break something. And the banking system has been feeling the brunt of it. And if you don't, see rates head lower, then the issues that the banks have had in the beginning of the year haven't gone away. They're still sitting on unrealized losses. Those don't go away, and that does change the behavior of risk taking in the banking system. If you're convinced that the Fed now will never ease rates or is on track to hike even further, that makes the banks even more defensive. And then both on their bond holdings, but also on the lending out through the credit channel, which will then mean less loans for the economy, and then you get this kind of vicious circle. Plus, there's existing legacy lending that was done at levels that the banks if they had to mark to market also would experience losses. And then this is just purely focusing on interest rate risk, right? And the problem that I feel like we're all in awe with the massive rise in rates, and that yes, many money managers as well as bankers haven't seen it, including myself. I mean, I've been doing this for over 20 plus years. The Fed never raised rates this fast in a short time period. So we're all in awe with what they've done. But if then that rate risk morphs into credit risk, then that's when the banks get even more risk averse, right? And that part hasn't really happened yet. We haven't really seen the credit losses pick up. And that to me is because the economy is still relatively, hanging in there, and people are still willing to pay their loans and pay back the banks. But at some point, if we do get into a recession, credit's going to get worse, right? And then you're going to see actual delinquencies become defaults, right? And even this year, I mean, there's been a running tally of a lot of bankruptcies already, right? There's been a lot of smaller bankruptcies, some bigger bankruptcies, but nonetheless, it's been one of the fastest years of bankruptcies. So the credit risks are surfacing. It just takes time as well.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. they can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. George, can you give me a sense of, because there's always that risk, right? And this is why central banks today are much more willing to go in and provide liquidity, because a liquidity strain can quickly turn into an insolvency strain if it's not actually handled appropriately. So can you've been talking a little bit about maybe a hanging sort of credit event, right? Which would definitely spell even more trouble for the banks and lead to tighter financial conditions. Does that always tend to follow a liquidity shock, or does it sometimes not end up materializing that way?
I mean, depends on the magnitude. So maybe let's go to page 26. This is actually one of my favorite charts that I've had for like literally decades. I've had this chart. In many ways, I've told both my colleagues and clients and anyone in between that this chart embodies basically the history of my career in many ways. This is like starting like from the late 90s all the way through today. And what I'm measuring here is two different money market funds, retail versus institutional. And then relative to the TGA, which I'm sure a lot of your listeners know what that is, the Treasury General Account, and where the US government keeps its cash. And the swings of this liquidity, and if it's happening at times where investors are becoming more risk averse and then moving into money markets, or being attracted to money markets because rates are higher, in money markets. Let's focus really on the purple line, because that's really what's moving here. When the purple line, institutional money, starts to kind of get defensive, and that's happening at the same time as there's either a debt ceiling issue that is then followed by a TGA rebuilding and restocking, that could create a whipsaw in liquidity and expose the have and have-nots. So there's that dimension. Now, what people are hoping for and banking on is that a lot of the money to help finance the replenishing of the TGA will come from the RRP. But if you go to the next slide, slide 27, we just don't know how sticky some of this money really is, and what are the alternatives. So looking at this is now the level. So the chart before was the change of these time series, but now we're looking at the levels of money, institutional money, and real money market funds. And there's a lot of different things here going on. One, when investors are getting defensive, they'll move into money or cash alternatives. You saw that in the number 1, number 2, number 3 annotated in this chart. But then look at what happened from like 2009 to 2019. Money market industry basically didn't move. And if we have time, we'll get to another chart in a moment, you'll see a similar dynamic happened to the small and mid-sized banks as well. In other words, all the excess kind of QE money didn't go into the money markets and went into risk assets or to other banks, right? And so during that period from 09 to 19, there was basically only the large banks, foreign banks that participate with the Fed through a lot of these QE programs. They're the ones that were the first kind of recipients of all that liquidity. And and so there's that dynamic, which is a whole other story. But this one, you saw the big rise after COVID when institutional money funds tapped their credit lines. But then it's been sticky ever since. It's not as if they paid back some of their loans. You can see the little black line dipped a little bit lower. Yeah. And now that we're in a higher rate environment, actually, money is staying within money markets. And there's only so much. Even if some of the TGA were to be replenished by the blue line, it's not clear all of it's going to be going down, and you're still going to see a lot of money outside of the traditional banking system, which then basically that's like inert money. It just doesn't flow through the real economy, because once it's in the money markets versus the banks can, and the dealers can put it back into the system. Repo could grow if money markets get more involved, but if they have a great alternative called the RRP, that becomes like dead money, inert, sitting there until the Fed drains it. So this is why the Fed really has to continue to shrink their balance sheet. They can't bank on the Treasury just issuing bills and that blue line going down. I think a little bit will go down, and it has already. But if it doesn't go down, it's going to come out of the banking system at a time where liquidity is precious.
Yeah. And just because this monetary plumbing can get very complicated really fast, would you mind just sort of outlining the importance of the reverse repo facility? My colleague Jack Farley has done a great job with Joseph Wang of describing how the Fed funds rate has become more important in sort of name only, and it's less important as actually a policy rate. And really the rate that gets paid on assets that are parked in the reverse repo is actually extremely important. And we haven't really talked too much about liquidity conditions at all, but I'd love if you could give listeners sort of a high level framework for how they should be thinking of all these entities, and then what does the liquidity picture sort of look like over the next 6 to 12 months?
Sure. And so, like this reverse repo program, which we call RRP for short,
Mm,
is another vehicle for investors, primarily non-bank investors that use it, deposit excess cash, or they can use it as an alternative asset because if there's not enough collateral or short-term treasuries or commercial paper or other short-term securities that are in the system, they can deposit that cash at the Fed. And as you can see, or those that are watching, there's been an increase in assets at the money funds. Both retail has been slowly grinding higher, very consistently, and then there's been this gap higher from institutional money. When that happens and there's not enough actual assets to buy, you can either sit in cash and earn zero, but that's not going to work out. And what happens is now that there's this reverse repo program that the Fed has, these investors can park it at the Fed, and the Fed pays a rate that keeps the Fed funds target within a range. Because they did not have this tool, rates would basically collapse to zero or close to zero if they didn't have the RRP. There's bank reserves, which banks also get paid their own different rate, and then there's cash in everyone's pockets or currency in circulation, and then there's the Treasury's general account, and the four of those, as well as a few other items on the liability side of the Fed's balance sheet, is what balances their balance sheet. Right? It's those four moving parts; those are the big ones, and the RRP has become such a big portion of the Fed's balance sheet. That if they want to shrink it, the balance sheet, they also have to shrink the RRP. So they have to find ways to encourage that. And so far, they haven't. Chair Powell was asked a question about that at the last press conference, and he kind of skirted it a little bit and is not focused on the balance sheet yet. But they should be, because this is really where the rubber hits the road. Because now that rates are high, the only thing now that matters is the amount of liquidity in the system.
Yeah, and you know what, George, you have this great phrase that I really like that I hadn't necessarily heard before, which is the liquidity haves and have-nots here. So I actually want to call on you before we sort of get to our final wrap up, sort of bigger picture questions. Can you just describe what you mean when you say the liquidity have and have-nots?
Sure. So, I mean, like if you look at page 28, this is looking at all the different QEs and how the Fed's balance sheet grew, the red line. And then we have this total banking system cash, which in many ways is the other side of the reserves that are in the system. Banks don't usually sit on cash unless it's either created, and a lot of it was created during the QE
Mm.
time period. And then there's the RRP, which is the reverse repo program. So those are the big ones, right? Like those are the banking system and the money markets. But if you go to the next page, this now breaks down that prior charts line of the banks into large banks, small banks, and foreign banks. So if you were to add up these three lines, they would add up to the total cash in the system. And you can see that it ebbs and flows with the different QE programs over time. And as I said before, the small banks from 2009, 2019 were not really recipients of the excess liquidity. That purple line is basically flat and growing at like a standard compound rate of like 3 to 5% per year. Just standard growth of the economy is what most small banks will see in terms of the deposit growth or cash savings over time. But after the repo mania / COVID shock and all the injections into the system from the CARES Act, as well as the Fed's actions, there was just a lot of extra liquidity in the system, and it's made its way into the small banks. I mean, small banks have never seen that sort of growth before in their cash levels. But even before QT started, it was already starting to go down. So like these were signals that were already showing that there was have and have nots within liquidity. And by the way, these things persist. This is pretty updated through last May, end of this May. Like there's this issue persists, right? So you see the little red line and went higher. That's the large banks, seeing a lot of the liquidity come their way after the banking turmoil of Q1, Q2. But nonetheless, we're talking about these dynamics are pretty much where we are today. And it means that if there's going to be further reduction in liquidity, it could disproportionately impact small to mid-sized banks more, all else equal. Right? This is a very simple statement, but just looking at the data, this is what's been happening. And if it were to continue, if we were to see further draining of liquidity, it probably would end up hurting the smaller entities more so than the bigger ones. And that's the whole point.
Yeah, and you mentioned this, and we've called that out a couple times on this show. But there was a very pointed question to Chair Powell about commercial real estate debt concentration in the small regional banking sector, and they hold something like 70% of outstanding debt. And Chair Powell said, to paraphrase a little bit, something along the lines of, well, if they're diversified across a whole bunch of different holdings, they'll be all right, and if they're more concentrated, and he kind of shrugged his shoulders, and I think that's all you really need to know. And I want to kind of start to wind down here by asking you some sort
Yeah.
of bigger questions. You put together a great chart here, which I really like, which is this idea of when you provide too much liquidity, it's extremely hard to unwind it. And it reminded me of, you mentioned Stan Druckenmiller earlier in this program. I've talked about, he gave this great interview recently. He did one at the Sohn conference. I think it was probably about 9 months ago now. And he has this quote that just really stuck out to me, which is, when interest rates are low for even a short period of time, people do dumb stuff. But when they're low for a long period of time, people do really, really dumb stuff. And I think that's the thing, that if you've been paying attention to markets, you've maybe been scratching your head a little bit and wondering, man, I know there's been some banking stress, but where are the fireworks that you would have expected in one of the most levered environments of, and certainly in recent history, and one of the sharpest, fastest rate hiking cycles in history as well. And you just haven't really seen as much stress materialize as you might have thought. Why do you think that is?
Well, look, I think it's the setup. That's the whole point. So this
Yeah,
chart on page 36, I mean, we've never seen M2 growth that high in a 1 year window rolling, right? Just
yeah,
continuous waves of liquidity and extra stimulus, which is still being working its way through. I mean, I think that it just takes time to actually work its way through, which is why I think for now the Fed could maybe look the other way if there were to see further bank issues. We'll see. But this is exposing again this have and have nots, and the more and more that both M2 and other forms of liquidity continue to kind of chip away at the excess, it's going to expose those that are more fragile.
yeah,
And again, it hasn't happened because it's just been just that excess out there that always comes in when things start to cheapen up, especially on the market side. So the public markets have had this tendency to buy the dip and to like look for value whenever things get cheap, not knowing what that really means. But there's more just like this kind of tendency to always see like a backstop coming in because there's excess liquidity in the financial system. It's going to be much more trickier for like hard assets, commercial real estate. We'll see how private credit fares in this environment because now that again, I think Fed's going to try to keep rates as high as possible. Now their funding costs have changed in a material way, which they're not used to after multiple decades of low rates and QE. So yeah, I think that's where it goes. As I said twice before, it's impatience. The
yeah,
markets just they want to see results now on all these actions, but we've had a counterbalance that's been providing like a lot of just this pool of liquidity underneath that's prevented things from really repricing as they should. But doesn't mean it won't happen.
yeah. So what, George? You're saying that human beings are impatient and they want things to happen immediately and no delayed gratification? This is all news to me. That's crazy.
Uh, exactly. Yeah.
Yeah.
Who would have thought, right?
Who would have thunk it? Yeah. Well, so one thing, I've been a little bit curious about and would maybe poke at you at is, when you mentioned that, if for those who are operating under the assumption that QE is going to be the same as it's always been, and the Fed is going to ride in here on their white horse, that's not going to happen for myriad reasons. Maybe the number one of which is that we have inflation, and it's definitely politically less popular now to pump infinite money right into the markets than it was in the past. I think though, a trend that I don't see how they're going to buck this, to be completely honest with you, and maybe you can help me out a little bit, is even if you rewind the clock back to when the great financial crisis was going on and they were proposing TARP, the unthinkable amount of money, right, that they came up with was 750 billion. right? And now, I mean, that's come on, that's a drop in the bucket compared to what we've had to spend. And even though we're reining
Yes.
back on the monetary side of things, we're still running a $2 trillion per year deficit for the next 10 years. So it's just hard for me to see. I hear you on the inflation side of things and why it might not be as politically popular, but for the life of me, I just can't understand how the next intervention wouldn't need to be as large. Can you help me kind of parse that out?
No, that's a great observation, and it's true. This is why many of us will normalize data and say it's relative to GDP. It's actually the same level, right?
Right.
But the nominal value is like 3x what it was 10, 15 years ago, right? So we're always having to kind of benchmark what this really means in the grand scope, and
In the
so
grand
I feel
scheme.
like that's a great observation. I think that the guardrails that are now basically being enforced is the inflation picture. It is the idea that we need to have some fiscal constraint, although there could have been more out of the debt ceiling deal, but nonetheless you had something take place. And by the way, they're gonna have to come back to this time and time again, right? So the debt ceiling dance that we do happens more often than I'd like to see. But it's that's still out there, and you can argue the merits of it. But that's not the point. The point is it's still a sort of guardrail. And then the question then becomes like, what is our priorities, both as a nation as well as as an economy, of like what are we trying to target and and really grow the economy to become in the future. And so if that requires a lot more government spending, but it comes at the expense of less innovation in the private sector, that's going to set us back in terms of real growth, right? So I think it's again, we're trying to figure out that balance. It's not an easy answer. I wish it was. I mean, otherwise policymakers might be able to figure it out too. But I think that it's more about the idea that look, we're gonna have more targeted stimulus going forward, both from the Fed as well as from the fiscal side, and the numbers might become bigger over time. Just naturally, that's what
Yep.
happens. But I don't think this idea that you can just like with a paint with a big broad brush and just dump all this money into the system and you hope that it finds its way into the right channels. I think those days are numbered. I hope I'm right,
Mm.
because I think that's we'll be better off for it in the long term. So I think that's what got exposed through this this massive experiment that we're going through, and hopefully we'll be better for it in the future.
Yeah. I guess in closing here, George, I would love to, if you were in Chair Powell's position or the Fed, how would you be thinking about reacting here? You mentioned that they might have some short of the infinite money QE bazooka. They might actually have some tools left in their tool belt. So how do you think they're thinking about things right now? I mean, are they making the right decision in terms of their, we're recording this in June, so their last decision was to pause, and they're signaling two more rate hikes near the end of the year. Are they doing the right thing, do you think? Or if you were in charge of the monetary system of the free world, would you be making different choices?
Well, I mean, look, who knows? I mean, none of us have a crystal ball, including the Fed,
Mm.
but we have the information at our disposal, and some of us with better tools and experience than others, and like that's really what we have. And if you look at page 40 to really kind of walk through, because you teed
Yep.
up the question, I think this one answers like, what would I be doing at this point? I think at this point you'd be starting to slow. You would actually start to highlight the growth risks, not just the inflation risks.
Mm.
Overlooking the growth risks, I think, is going to come back to them, and they're going to realize that all these indicators were right, maybe a little bit early because of a calibration issue. Post pandemic, things are just not the way they used to be. But I don't think the curve is wrong. I don't think all these other indicators are wrong. It's just a matter of the timing of things lining up. And once the job market finally starts to go, like having to pivot so hard is going to actually be a negative in the mind of the market. So saying like you got this wrong, you should have been slowing down and not tightening as aggressive. You overdid it. So I think reintroducing an easing bias by the end of the year and actually maybe following through with it, and that's a way you might try to soft land. But the idea of just staying tight, 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 and then hope that you can pivot and that you're going to catch it the right way. I think that's what's going to get them. They've overstayed their welcome in tightening side, but they're doing it in many ways to try to allow this liquidity to continue to drain out through QT. So I think it would be this idea of this, like they should now use this opportunity like this whole thing of physics, a body in motion stays in motion, right? So when you're
Mm,
hiking, like that's an easy message to deliver. The next meeting, you hike again. You just keep hiking, hiking, hiking. Now that you have a pause, it should be a pause to reflect. They have to reflect on all of their cumulative actions, and they have two tools going on at once, which is the rate channel, very high now, which we haven't seen in many years. And arguably it hurts a lot more now because we have a lot more leverage in the system. And the liquidity side, which the system has gotten used to all this excess liquidity. So if you're trying to drain that and keep the price of money super tight and high, that you need to like explain why are you doing it, and then start to also talk about the balance sheet more, not just the rate channel. If they were to do those things and start to walk us down towards, eventually they're going to have to introduce insurance cuts at some point, because I do think that we're heading into a slowdown. The banks will need a steeper curve to re-engage in lending, and also, we'll eventually see that we're late cycle, maybe already in a recession. But again, that's what I think should be doing. We're in the business to try to figure out what they're going to do next. And I think we're 50-50 that they might try to hike one more time. And I think that might be a policy mistake at that point. History will be the judge of that. But I think that they've probably done enough as it is. Focus on the balance sheet, on explaining why they have an enlarged balance sheet. If they're trying to shrink the RRP, figure out a much more dynamic way of scaling down the size of the RRP without it just being relying on the TGA side of it. And then see what kind of economy we get in the next 6 months to a year. But we'll see. That's what I would be doing.
yeah, yeah, I tend to agree with you there, George. And some small part of me thinks that sometimes we look at the Fed and we try to really get in their heads and assess and what could Chair Powell be thinking here and yada yada. And I think that the objective has been pretty clear and very succinctly stated since the beginning. He's very concerned with beating inflation and restoring price stability. And even though
Whatever it takes. Yeah.
whatever it
Yeah.
takes, and even though
Yeah.
we've seen Fed funds
Yeah.
climb above CPI, we know that what they really care about, right, is core PCE. That's their preferred measure of inflation, and that has still been persistently strong. So, I don't really want to go out on a limb here. There are so many people that are better Fed watchers than me, but if I had to put myself in, Chair Powell's shoes, a pause is waiting. I think they're just sitting there, fingers crossed that core PCE measure trends down, and then they can say in a couple months we're data dependent, and the data has showed us that inflation is finally turned over, and we're not going to get those hikes. So
Yeah. I agree. I
maybe
really
that.
hope that's the environment. It still doesn't mean you don't run the risk of that becoming still a policy mistake, in the sense that you've done a lot already, and then you might get the aftershocks, which will be financial in
Yeah,
nature. If it's purely just macro, and again, we have this immaculate disinflation, and everything kind of stabilizes, and they are able to ease in a very orderly way, then that's actually great. I mean, that's the environment that we should all hope for. They're not admitting that, because they're trying to say that they're tough on inflation and they're trying to win that war first. But the real war is trying to have a sustainable recovery. Like, we need a sustainable recovery that benefits all. I think they're gonna have, it's gonna be hard to kind of thread that needle.
yeah, I agree with you there, George. Last question for you, and then I know we've got to run. One question that I thought was super interesting from the last presser is, again, there was that reporter who sort of had said something to the effect of, "Hey, we know you're doing what you can on the monetary side of things. Your fiscal policymakers, right? They are the ones who are still saying we want to spend $2 billion per year. In 10 years, we're going to have a $50 trillion deficit." And I know you mentioned, the scale of the intervention sort of scaling with GDP, but debt to GDP has been going up as well. And I guess in closing, my closing question to you is, it seems Chair Powell is actually very dedicated to bringing down the inflation problem using the monetary tools at his disposal. Can he be successful though if the fiscal policymakers seem to still be on the spending warpath? Because that seems like that's making his job harder.
Yeah, look, this topic we could probably spend another 15,
Another
20
whole, yeah,
minutes
yeah,
on.
yeah,
Yeah, that's a whole other topic. But I mean, if you want to scroll back to page 38,
yep,
this is comparing real rates versus the inverted debt to GDP, and you can see that we've been able to take on more and more debt because our real costs have been coming down up until the last year and a half, right? Like, at some point, Fed policy, which is also driving overall rates higher, but at some point, the bond market, or the bond vigilantes, whatever you want to call them, the bond market will step in and say, the government's spending too much, and or if the government's spending too much and that's resulting in higher rates or a crowding out of the economy, things start to short circuit anyway. We're not yet there yet on the short circuiting because overall rates are still historically not that high. But in terms of future debt growth, if we're going to really see like just nonstop deficit spending, it's going to result in slower economy over time, and we can't afford high rates like this because eventually, still, like, as I say here, somebody has to buy all that debt, and it cannot just be the Fed, and it's going to have to be from the private sector. So that'll just crowd out credit.
Yeah. George, unfortunately, we're at the end of time here. I wish we could have kept going for that 15 or 20 minutes because I am just very interested in this idea. But guys, if you've been listening, I'm sure you've probably come across George before, but highly recommend that you go and follow him on Twitter, check out more works. George, if people want to find out more about you or follow you or subscribe or whatever it is, what's the best way to do that?
Sure. I mean, so I also do a bi-weekly podcast at MUFG podcast. You guys can subscribe there. I also post them on Twitter, so you're probably better off just waiting for me to post them on Twitter, and I'll explain like the overall logic of the podcast. It's like real time, kind of forward looking, like on what to think about in the markets and the economy and in the near term. And of course, my handle is at Bond Strategist, so that's the place where to follow the work and the stuff that I'm looking at.
Great. Thanks, George. We will link all of that in the show notes. Really appreciate your time today. Had a great time talking. We'll have to do it again soon.
Yeah, me too. Thanks for all the questions. Appreciate it.
All right. Cheers. Bye.
Bye.